And I'm going to put an arbitrary forward rate here. I'm going to make that a different color. I mean, I can actually write a formula for the forward rate, but just to show you the idea, I'm going to do let's put a 4% for now, amount paid with forward. I'm going to borrow $1 million, pay the forward interest rate for 5 years. I'm going to make that, leave it like that. I'm going to do a difference. If I got the forward rate correct, amount paid with forward should be the same as amount to pay using the poor man's forward. So what I'm going to do is data, what if analysis, goal seek, make this difference 0 by changing the forward rate. Okay. Again, I can write a formula for the forward rate. It beats the point because this kind of shows you that you need to pick the rates so that they're equal. Instead of writing a formula where I can make mistakes typing the complicated formula, I'm letting Excel do the calculations. In fact, I haven't bothered here, but we could use our solver friendly goal seeker to make that even automatic. I'm just not going to worry about it in this class. As you can see, forward rate is actually higher. If it was reverse, for example, let's look at 1 and 2 years right now. 1 year is 366, 2 year is 352. Three six six two. 2 year is 3527. Now let's do our goal seek again. Make this thing 0 by changing the forward rate. As you can see, forward rate is now less than both of them. Why? During the span of the forward agreement, spot rates are actually going down. All right, I'm going to leave it there for now. We'll talk more about these when we do interest rate swap agreements, because they typically depend upon what the forward curve looks like. It's the curve of the forward rates themselves. And once you have that, you can make other calculations. But that's where those forward numbers are going to come from. Oddly enough, when swaps first started, the spot market was the most liquid. So spot market determined the forward rates determined the swap rate. Now the swap markets are so liquid, you actually should start with the swap market and reverse engineer the spot rates and forward rates. You can kind of bootstrap to do that. I'm not going to do it in this class. If we were doing I mean, I'm going to propose this, but I'm going to propose a class on fixed income securities. In a class like that, which would be just for banking majors, I would cover it. All right, going back to, okay, all right. There are also instruments called euro notes. These are essentially uh, internationally syndicated bonds that have medium-term maturities, anywhere from 3 to 10 years. In fact, anytime the maturity is over 10 years, sometimes we call them bond. So that's the difference between a note and a bond. It's just terminology. One of the most useful and liquid uh, euro currency instrument is the euro commercial paper. Do you guys know what a commercial paper is by itself? They're basically short-term borrowing instruments issued by corporations. You know, Bank Treasury issues a 3 month thing, we call that Treasury bill. But if Apple issues a 3 month instrument where they're going to pay you $1 million 3 months from now, that is called a commercial paper. It's basically short-term bonds or short-term pure discounts uh, borrowing securities that are issued by corporations. That's the only difference between treasury bills and commercial paper. And these markets are very, very liquid. In fact, you don't even have to go to banks to get euro credits. You can issue euro commercial paper. Everybody comes in. Another thing that's important about euro commercial papers, in general, commercial papers as well. Do you guys know about the money market funds? These are mutual funds that can invest only into securities that have 90 days or less to maturity. So instead of putting your money to bank overnight, if you have money that's if you have high amounts of money, put it into a money market fund, because those guys actually invest into a combination of things, but commercial papers, typically a big portion of that, you tend to get higher rates of return. You already have basically built-in clients for those papers. Of course, if your credit rating is not that high, nobody's going to buy it. But if you're Apple, you're either AAA rated or AA rated, you're not going to pay too much premium over T-bills. And nobody expects Apple to default in 3 months. Even something like a triple B, which is called the lowest end of the investment grade credit rating, you won't have any problem doing these. I'll come back to these software contracts in chapter 14 because they're somewhat involved. All right, let's briefly talk about some of the historical crises that we have seen and how it affected international debt and money markets. The first big problem was back in early 80s. And the reason for the early 80s, as we talked about last time and before, 1970s was pretty problematic times for not only US, but for most of the developed countries. but it also affected some less developed countries. Oil prices went up. In fact, if you're a country like Mexico, at that point, Mexico didn't have too much oil themselves. Offshore stuff had not started yet. Or if you're a company like Uruguay, Brazil, again, you didn't have oil fields, and a lot of your economy depended upon oil imports. If those prices tripled overnight, you're going to be in serious trouble. But until then, a lot of US banks, especially, have financed these regimes. If you know anything about the history of Latin America, for example, basically whoever got up the earliest did a coup d'etat. It was a series of military dictatorships. The worst case examples were Paraguay, Brazil, Argentina. Um, any of you guys watched the movie Kiss of the Spider Woman? The old version. There's also a musical version of it now. Jennifer Lopez apparently was going to play on that. Uh, Argentina was a military dictatorship until about 1982. Then they lost the Falkland War with UK, and they kind of somewhat became a democratic country. But these banks lended money in 1970s to these countries. Why? Relatively speaking, they were under US control. Most of those coup d'etats were CIA engineered anyway, not necessarily explicitly. In the case of Chile, for example, it was explicit. In 1973, there was an election in Chile. A socialist slash communist guy won the election, Salvador Allende, or I'm sorry, Allende. And within 6 months, there was a coup that was explicitly engineered by CIA. And general called, I know last name, first name was Augustine, I think, Pinochet. He became a dictator. I think he stayed over until early 90s.